OnBill repayment is a mechanism used to improve the creditworthiness of energy efficiency investments by having them repaid within the utility or tax bill and recovered through the existing payment collection infrastructure of utilities or public authorities. This levers the existing payment relationship between customer and utility or tax authority and directly provides a credit history giving an accurate view of likely defaults. As customer payment history with both utility and tax payment are long and exhibit low default rates compared to other consumer finance. OnBill repayment has been used mostly for investment in buildings, but some schemes in the U.S. target industry and SMEs. OnTax Finance, PEACE. The U.S. Property Asset Clean Energy, PEACE, is a key example of OnTax financing. PEACE consists in a scheme in which money is lent to a building owner to retrofit a building, but the loan is attached to a property and reimbursed through local taxes by the occupant. The fact that the payments are integrated in local taxes enhance their creditworthiness, since taxes have almost no payment rates in the U.S. and they are senior to any other debt. If the building is sold, the loan can be reimbursed or taken on by new owner. If the building is rented, it is the tenant who pays the tax and benefits from the savings, and to change of tenants has no impact of the repayment. Financing can be provided by the local authorities or by private funds. In the latter case, the role of public sector is to secure reimbursement by integrating in the tax collection, usually against a collection fee, while it's private companies that are in charge of engaging building owners and signing contracts with them. Energy performance contracting, private sector provider. An energy performance contract is a contractual arrangement between a host beneficiary and the provider of energy efficiency improvement measures, verified and monitored during the whole term of the contract. Investments in that measure that can take the form of work, supply, or service are paid for in relation to a contractually agreed level of energy efficiency improvement or other agreed energy performance criteria, such as financial savings. An important element of energy performance contracting for public authority is how the investment is in the energy efficiency improvement is recorded on government balance sheets. There are two options. Either the investment can be recorded on balance sheet as a debt, so an investment is a new energy efficient lighting system costing $100,000 will count as a debt, because many governments face statutory limits on how much debt they can take on. Counting on energy efficiency investment as a debt can limit the ability of government to invest in energy efficiency. Or the investment can be counted off balance sheet. In this case, ESCO is recognized as the economic owner of the energy efficiency investment and therefore carries the risk rewards associated with investment. In another example, the government might be paying $100,000 an increment of $5,000 over 20 months. In this case, the monthly payment will be counted as an expenditure on the government balance sheet, but the initial investment of $100,000 will not be counted as a debt on the balance sheet. Energy performance contracting is widespread and an adaptable instrument. While it's slightly better used by larger companies, energy performance contracts clearly have a widespread application in funding corporate energy efficiency investments. The growth of energy performance contract usage for corporate energy efficient investment can be accelerated through the clarification of their accounting treatment for hosts and their regulatory treatment for banks and insurance companies. See further analysis in Section 4. In addition, the emergence of new insurance products portfolio, refining alternative contracting and procurement standards, reduction of transaction costs, and greater trust from project hosts will support energy performance contract growth. Energy Services Agreement. The Energy Service Agreement, ESA, is a pay-for-performance service contract between a third-party investor and an asset owner to deliver energy saving as a service. The ESA is in some ways an evolution of the traditional shared saving model provided through energy performance contract EPCs, but it is structured more like Power Purchase Agreement PPA and used more frequently by actors in the mainstream energy market. A third-party investor and an asset owner enter into a ESA contract, typically for 10 years, where the asset owner agrees to pay their historical utility bills to the third party. An upfront access fee for an ongoing utility bill discount may also be paid to the asset owner as an incentive. The third party invests into money-saving energy-efficient opportunity and owns and operates the energy equipment to provide energy services to the asset or building. PublicESCOs can also reduce the cost of financing by aggregating specific credit lines, public grants, and other incentives, especially if the public body establishing it provides guarantee or capital to deliver a strong credit rating. PublicESCos mainly tackle public buildings, taking advantage of adapted public procurement rules and, in some regions, certain types of residential buildings. Leasing. Leasing is how the host obtains the use of machinery, vehicles, or in the case, highly energy efficient equipment or other EE measures on rental basis. This avoids the host need to invest its own capital in the equipment. Ownership rests in the hands of the lessor, who is generally a financial institution or leasing company, while the business has the actual use of the equipment. Applied to energy efficiency, it can be used to overcome the issue of higher upfront cost for energy efficiency investments as payment in a lease merge capital and operational expenditure. Leasing can support the incorporation and uptake of highly energy efficient equipment purchases for companies as a widely used alternative for financing or machinery, equipment, and vehicle lease offer a window into a natural replacement cycle of company assets. And of balance sheet treatment of leases and wrapping off the interest, capital, and offered service payment into one makes them simple and capital efficient for company to manage. Policy program providing additional fiscal or accelerated depreciation support the selection of highly energy efficient equipment can be combined in the context of lease to improve the energy efficiency performance of equipment renewal and deliver more benefits to the corporate host.